Welcome to This Explainer. Today we're digging into a massive corporate mystery. How on earth did the undisputed king of streaming, a platform that literally conquered global culture and totally reinvented the music industry, somehow spend over a decade struggling to actually make a profit? It's a wild story of incredible scale, a hidden structural trap, and a multi-billion-dollar, high-stakes pivot that is completely reshaping the audio landscape as we know it. Let's dive in. Over 600 million users. I mean, let's just pause and think about the sheer scale of that cultural footprint for a moment. To put that staggering number into perspective, that is nearly double the population of the United States, all hitting play on a single app. This massive user base undeniably cemented Spotify as the absolute ruler of our ears, right? They completely changed how we consume culture, how we discover new artists, and how seamlessly music integrates into our daily lives. By all traditional metrics of the digital age, capturing 600 million users means you have emphatically won the game. But here is the paradox at the very heart of this story. For years, acquiring all those users didn't magically equal profit. In fact, it led to massive bleeding losses. It totally defies the golden rule of tech giants. Normally, you build a platform, you scale it globally, and the profits just roll in exponentially. But for Spotify, the bigger the crowd got, the wider the financial sinkhole became. It was this astonishing disconnect between massive popularity and actual financial viability. Part 1. Surviving the royalty trap. Okay, so when we think of streaming, we usually lump all the big players together. But underneath, their engines operate entirely differently. Take Netflix, for example. They operate like a giant vault. They own their hit shows, which creates a fixed cost. They pay millions to shoot a season of television, but whether 10 people stream it or 10 million people stream it, that initial production cost never changes. Spotify, however, they're essentially just renting the music. They don't actually own the songs. They just built the pipes to deliver them. And that creates a highly volatile, variable cost structure that fundamentally altered their financial trajectory. And this dynamic creates a relentless financial bleed. The math is pretty brutal. Roughly 70%, literally 70 cents of every single dollar Spotify makes, goes straight out the back door. It flows directly back to rights holders and a few massive record labels, companies like Universal, Sony, and Warner. That leaves Spotify with a meager 30% slice. Out of that tiny fraction, they have to fund global app development, marketing, employee salaries, and massive server infrastructure. When you're legally bound to hand over the vast majority of your revenue just for the right to keep the lights on, profitability becomes a terrifying uphill battle. So, this is the textbook definition of a variable cost model. In plain terms, scaling up streams inherently scales up their expenses. Every single time one of those 600 million users hits play, a tiny fraction of a cent is owed. If users listen to twice as much music, Spotify owes twice as much money. It's kind of like running on a treadmill where the speed just keeps increasing. They couldn't just grow their way out of the problem because the costs ballooned right alongside the revenue. Part 2. The pivot to everything audio. To break free from this relentless trap, Spotify knew they couldn't just sit still. So they initiated a massive, multi-billion-dollar counterattack, aggressively pivoting away from just music. They spent hundreds of millions acquiring exclusive rights to blockbuster podcasters and buying up entire podcast networks, all while building a vast library of audiobooks. They weren't just trying to be a music player anymore. Actually, scratch that, it was more like they were attempting a full-scale monopoly over the entire ear-share economy. This was a fundamental shift in corporate strategy, backed by breathtaking financial bets intended to permanently alter their trajectory. The logic behind these massive bets was a direct attack on that royalty trap. By owning this new non-music content directly, or paying flat upfront fees to creators, Spotify finally changed the math. If they own a hit podcast and it explodes to millions of listeners, they don't have to fork over 70% of that ad revenue to a record label. They keep it. By shifting away from variable costs and building a foundation of fixed costs, they finally allowed their profit margins to grow as their audience scaled. Part 3. The new efficiency era. And that brings us to the present day, where the rules of the streaming game have been completely rewritten. We are witnessing a harsh, industry-wide transition. The historical growth at all costs mindset, where Wall Street rewarded tech companies simply for gathering users, is completely dead. The economic climate shifted, interest rates rose, and the demand became ruthlessly simple. Show us the money. Spotify proved they could gather the users. Now they had to prove the business could actually sustain itself in a tightening market. Okay, So how are they proving this model works in real time? Through a ruthless two-step strategy. Step 1, aggressively slashing internal operational expenses. Unfortunately, this meant painful layoffs, cutting unprofitable exclusive deals, and adopting a much leaner, less extravagant corporate structure. Step 2, raising subscription prices. For over a decade, the $9.99 streaming subscription was seen as this untouchable ceiling across the industry. By finally breaking that barrier and extracting just a little bit more revenue from their existing highly loyal user base, they forced the math to finally work in their favor. Part 4, owning the margins. What this entire corporate journey really proves is that having 600 million loyal users is only half the battle. It grants you immense cultural power and a seat at the table, sure, but true business dominance comes from controlling your own profit margins. Spotify realized that being the most essential app on our phones meant absolutely nothing if the underlying financial engine was fundamentally broken. Their aggressive pivot into everything audio wasn't just about offering more content. It was a desperate and ultimately successful war to finally own those margins. Which leaves us with a final thought, one for your own wallet. As Spotify's transitions into this era of sustainable profitability and their grip on the global audio market tightens, how will that change the price you're ultimately willing to pay? Will the platform you depend on tomorrow look and cost fundamentally different than the one you fell in love with yesterday? Thanks so much for joining me for this explainer. I hope it helps you see the streaming economy in a whole new light.